We are going to talk about the cornerstone theory of the modern finance, the capital asset pricing model. Like all economics models, the capital asset pricing model has a set of assumptions as well. The assumptions on the markets and assumptions on the investors. We look at assumptions on the markets first. All investors are price takers, means all investors are small investors. They can only take whatever the take price of the asset. They cannot make the price. All information relevant to security analysis is free and publicly available, means the information is free and whoever want to access it, they can get it. It's free of charge. All securities are publicly owned and traded. So here, under the campaign model assumptions, all securities traded privately are excluded from the model. There are no taxes on investment returns and no transaction costs. Lending and borrowing at the same risk-free rate, and they are unlimited. You can borrow as much as you want. There's no limit. It doesn't really matter whether you borrow or you lend, you have the same rate. The assumptions on the investor side. First, this is a one single period game. All investors plan for the same single period horizon. This is not a multi-period game. Investors are efficient users of analytical method. They have homogeneous expectations. Homogeneous means same. All investors have the same rational expectations. For example, if your expectation of the S&P 500 is 7% annually, all other investors have the same homogeneous expectations. Investors are rational mean variance optimizers, means the investors are all rational and using the same mean variance tools we introduced in the previous chapter. They maximize the return, minimize the variance. They're using exactly the same set of analytical methods. If all the assumptions are satisfied in the capital asset pricing model, then we can reach the hypothetical equilibrium point. At equilibrium, what happens is all investors will choose to hold market portfolio. Market portfolio is the portfolio of all assets public traded in the markets. In reality, we most of the time use S&P 500 as the proxy for the market portfolio. The market portfolio is on the efficient frontier, and the market portfolio is our optimal risky portfolio. Remember, the optimal risky portfolio is the portfolio everybody has to hold in their complete portfolio. It's just a matter of what percentage you put in the optimal risk portfolio and what is the percentage you put in the risk-free asset. The risk premium on market portfolio is proportional to the variance of market portfolio and investors' risk aversion. The risk premium on individual assets are going to be proportional to the risk premium on market portfolio and proportional to beta coefficients of the security on market portfolio. I will introduce what is beta in the later slides. When we connect the risk-free asset and the market portfolio, we form the capital market line. The capital market line tangent to the efficient frontier. The tangent point is the market portfolio. So in this risk and return space, we can see the market portfolio's return is the expected RM. The market portfolio's risk is sigma M. The capital asset pricing model promotes the passive strategy, which is also the mutual fund theorem. It means all investors should hold the same portfolio of risky asset, which is the market portfolio, the portfolio consisting of all public traded assets. and can be satisfied by a single mutual fund composed of that portfolio. You can think of that portfolio as S&P 500 because most of the time we're using S&P 500 as the proxy of the market portfolio. So basically, what we are talking about here is passive strategy or mutual fund theory means all investors should just hold S&P 500, a proxy of the market portfolio. Market portfolio is all you need, and that's it. Now you may question, if everybody follow passive strategy that is costless and efficient, why would someone follow active strategy at all? Is active strategy useful at all? Well, the problem with the passive strategy is, yes, it's costly and efficient. It basically says everybody should just hold a index, say S&P 500 market portfolio. But the problem is, if everybody does that, then no one will do the security analysis. No one will bring back the asset price to the fundamental. What I mean is, if everybody hold S&P 500, everybody put their money in S&P 500, a big portion of the S&P 500 are in the big firms, say Facebook, Apple, Alphabet, right? If everybody put money in those big stocks, it will drive the stock price higher and higher and higher. No one is going to bring them back because everybody is just passively investing in the S&P 500. They are just going to push the asset price up and up and up. If the fundamental of the asset value is way below the current market price, if there's no active traders shorting the stocks, bring back the stocks to the fundamental values, the bubbles will just become bigger and bigger and bigger. That is the problem with everybody holding passive strategies. So we actually do need active strategies, active traders to do asset analysis and bring back the market price to the efficient level or to the fundamental true value of the assets. Let's talk about the risk premium of market portfolio. By definition, that is the return of the market portfolio minus the return on the risk-free asset. So basically, you can think of risk premium of market portfolio is the excess return of the market portfolio over the T-bill rates. Again, whenever we talk about market portfolio, we can always use S&P 500 portfolio as the proxy for the market portfolio. Okay, so here, the demand of the market portfolio will drive the price up. If everybody want to invest in the market portfolio, then the market portfolio price will go up, right? So higher demand drives up the asset price. If the price goes up, which means the expected return of the asset or the expected risk premium will be lower. For example, if you purchase S&P 500 at $3,000, the expected return is, say, 7%. But if you purchase the S&P 500 portfolio at $3,500, means you paid a more expensive price, then the expected return will be lower because your purchase price is too high, right? So there is an inverse relationship between the price and the future expected return. The lower the price you purchase the asset, the higher the expected returns on your investment. The higher the price you pay for the asset means you bought it more expensively, so the expected return on your investment is lower. Is that right? Okay. So high demand drives up the asset price. High asset price lower the return or lower the risk premium of the market portfolio. When the premiums fall, means the expected returns fall, the investors will move funds to risk-free assets because the premium is the excess return over the risk-free asset. If that excess return is falling, So the investors will have less incentive to put their money in the high-risk assets. In the equilibrium, the risk premium of the market portfolio is going to be proportional to two things, which is the risk of the market. The second one is risk aversion of the individual investors. Now we can deliver the capital asset pricing model. Basically, the model says the expected return on any individual securities will be proportional to the asset's beta and market risk premium. So if you look at the formula, expected return of any stock I equals the risk-free rate, which is the T-bill rate, plus the beta of the stock, beta I, times the market risk premium. Here, beta is the covariance of the individual assets with the market portfolio divided by the sigma square, or the variance of the market portfolio. Beta is a very important concept. When you turn on the TVs, check the internet, people talk about beta all the time. So what is beta exactly? Let's take a closer look. The definition of the beta is covariance of individual assets return with the market return divided by the market risk, which is measured by sigma square variance. Let's rewrite beta in terms of correlation, because correlation is a number ranging from -1 to 1. We like it better than covariance. So the covariance equals the correlation times sigma m and sigma I. So the sigma m in the numerator will cancel out with the square in the denominator. So we can simplify beta into two terms. The first one is correlation of the market return with the individual assets return. The second term is the ratio of the standard deviation of any individual asset over the market standard deviation. So basically, you can think the second term as the ratio of the relatively risk over the market. Let's plug in some numbers to take a look at the different betas. The first example, now suppose we have an individual asset E. The correlation of the asset E and the market portfolio return is about 0.5. Asset E is a lot riskier than the market portfolio. So the ratio of the sigma E over sigma M is roughly 2. Let's see what is beta. So the multiple of the two numbers, roughly 1. So beta E is roughly 1. If we plug 1 into the campaign model, then we can see the risk premium of asset E roughly equals the risk premium of the market portfolio. In that sense, when beta equals 1, that is for very big and mature firms, which is strongly correlated with the economy, for example, Disney. So on average, when beta equals 1, that asset is market portfolio, or that asset has the same return as the market portfolio. Now we have a second asset E. The correlation of the asset E and the market is a lot higher at 0.75. The standard deviation of the asset E over standard deviation of the market is roughly 4, which means asset E is 4 times riskier than the market portfolio. Multiply the two numbers, we have beta equals 3. Plugging in beta equals 3 into the campaign model, we have the risk premium of the asset E roughly equals 3 times the market risk premium, which means the expected return of the asset E is a lot higher than the expected return of the market portfolio. So when beta is greater than 1, those are for very small or high growth firms, extremely sensitive to economic cycles and with very, very high idiosyncratic risk, means standard deviation. Now finally, let's take a look at another asset E. The correlation of the asset E with the market is roughly zero, so there is no correlation at all. Asset E itself is extremely volatile. As you can see, the standard deviation of asset E is 10 times the market standard deviation. It's a very volatile stock, but it has nothing to do with the market movement. So the correlation of the two is zero. Let's multiply the two numbers. Beta equals 0 because 0 times any number is still 0, right? So we plug in beta equals 0 to the campaign model. Then the expected return of the asset E is the risk-free rates. This seems very counterintuitive. The asset is extremely volatile, very high volatile, and it had zero risk premium. It has exactly the same return as the risk-free asset. Why? Because under the campaign model, our critical risk is covariance, not its own variance. The covariance with the market, because higher own variance can be diversified away from including many assets in the portfolio. So in a very diversified portfolio, we don't have to worry about individual assets' own risk. Now we can summarize. The campaign model says the risk premium on any asset is proportional to its beta. The beta of the market portfolio is 1. Stocks with beta greater than 1 are riskier than the market portfolio. Stocks with beta less than 1 are less riskier than the market portfolio. Now let's do some exercise. What is the beta of a portfolio with expected return 18%, risk-free rate 6%, market return 14%? So now we can plug in all the numbers in the campaign model. We have 3 known variable and 1 beta unknown variable. We can back out the beta, which is 1.5. Beta equals 1.5, which is higher than 1, so this asset is a lot riskier than the market portfolio. The risk-free rate is 6%, expected market returns 12%, beta 1.2. What is the expected return of the security X according to campaign model? So you can directly plug in all the numbers. 6% risk-free rate plus 1.2 beta times the market risk premium, which is 12% minus 6%. The expected return is about 13%. So this is one important application of the campaign model, because the beta of the asset is a reported number on any financial website, say Yahoo Finance, Google Finance. It is a relatively stable number. Once we know the asset's beta, and then we also know the T-bill rates. That is also publicly available data. The market risk premium, which is S&P 500 return minus the T-bill rates. The average S&P 500 return is roughly 7% based on historical numbers. So all the numbers are given. Plug in all the numbers, we can calculate your expected return on any individual assets. So when you purchase the stock or purchase the asset, plugging in all the numbers in campaign model, you can have a roughly idea or a expectation of what is your stock return in the future. In a simple campaign word, which of the following statements are correct? 1. All investors will choose to hold the market portfolio, which includes all risky assets in the world. This is correct because in the equilibrium point of the campaign model, all investors will choose one optimal risky asset portfolio, which is the market portfolio. And you can think market portfolio as S&P 500, which is a very good proxy for the market portfolio. 2. Investors' complete portfolio will vary depending on the risk aversion. That is also correct. In the campaign world, everybody will hold the market portfolio as the optimal risky portfolio. But what percentage you want to put in the risky portfolio? 10%, 80%, 100%? So that percentage will depend on the risk aversion level of the individual investor. If the investor is very risk averse, means very conservative, the investor will put less weight in the market portfolio, say 10%, 20%. A lower risk aversion investor means the investor can take higher risk. That investor will put more percentage in the risky portfolio or the market portfolio, say 60%, 70%. Okay? So basically it says everyone in the campaign world will hold the market portfolio as their optimal risky portfolio when they form their own complete portfolio. But in the complete portfolio, what percentage of money you want to put in the risky portfolio, what percentage you want to put in the risk-free asset, depends on the risk aversion level A. 3. The market portfolio will be on the efficient frontier and A will be the optimal risky portfolio. Yes, the tangent point of the capital market line with the efficient frontier is the optimal risky portfolio. Now before we move on to the next section, I want to have a very quick review of the capital allocation line. In our return and risk space, vertical line always expected returns, horizontal line always standard deviation. If we connect the risk-free asset, in this particular picture 5% return, 0% risk, and a risky portfolio, portfolio P, return 11%, standard deviation around 14%. If we connect the 2 points, we will have the capital allocation line through the portfolio P. And we have the tangent point P, which is the optimal portfolio. The curved line is the opportunity set of all risky assets. I want to emphasize, up to this point, we always use the standard deviation as the measure of the risk. So if you check all the pictures starting from this point and before, you can see on the horizontal line in the pictures, we always have standard deviation as the measure of the risk. Now I will introduce a similar line called security market line in the risk and return space. We look at the picture first. On the vertical line, we have the expected return, just like what we did before. But on the horizontal line, instead of using the standard deviation as the measure of the risk, now we are using beta as the measure of risk. So in this risk and return space, we can plot the campaign model relationship in the picture. Recall the campaign model. I write down the formulas on the left-hand side of the slides. So let's take a look at the security market line. If we start from the risk-free asset, RF in this picture, we have 1 point in the picture. The second point is the market portfolio, which consists of all risky assets in the world. If we connect portfolio M, the market portfolio, and the risk-free asset, RF, 2 points, we have one straight line. That is called security market line. So portfolio M has expected return Rm and beta equals 1. As we introduced the beta before, market portfolio has a beta equals 1. Okay, let's take a close look at the security market line. First, what is the slope of the security market line? The slope will be the distance of the vertical line, which is the market risk premium, expected RM minus the RF, divided by the distance of beta, which is just 1. So the slope of the security market line is just market risk premium divided by 1, which is still market risk premium. So the slope of the security market line is the market risk premium. The security market line plots the relationship of the campaign model. So basically it says if a stock is fairly priced, it should be located exactly on the security market line. Any asset that is fairly priced should be exactly on the security market line, not above, not below. Okay, let's take a look. Now we have a stock which is located above the security market line. Let's see what happens. In this numeric example, if the stock price is fairly priced, it should offer a return of 15.6% according to the security market line. But temporarily, the stock has a positive alpha, which means the stock located above the security line, which offers a higher return, 17%. Any rational investor will love this stock because the stock offers you a higher return. If investors love this stock, they will all rush to the market and purchase the stock. When the demand for the stock is high, everybody is buying the stock. It will drive the stock price higher, right? Everybody is trying to buy the stock, which drives the stock price higher. The higher price means lower expected returns. There is an inverse relationship between the price and the return, right? The higher the price you purchase the stock, the lower the possible return in the future, right? Because you bought it more expensively. Okay, higher demand of this stock will drive up the price of this stock, which will drive down the return of the stock. So basically, everyone rush to the markets, drive up the price, drive down the return. So the alpha is going to gradually decrease until the stock offers exactly 15.6%. Then no one will have extra incentive to purchase the stock. So positive alpha is always going to be temporary because people will have incentive to overweight or to buy the stocks, which will drive up the price and drive down the return until the stock return lies exactly on the security market line. So the stable point will always be on the security market line. Any points above the security market line is not going to be on the equilibrium point. It cannot last long. In the equilibrium point, the more stable point, the stock return will be exactly on the security market line. In the previous slides, we showed if alpha is positive, means the stock return is located above the security market line. Everyone will buy and drive down the return. Now let's take a look. If alpha is negative, means the stock is located below the security market line. What happens? Negative alpha means the stock return is lower than the return should be on the security market line. A negative alpha stock means people will sell the stocks because it offers a lower return. When everybody sells the stock, it drives down the stock price because if everyone rushes to sell, the stock price will be driven down, lower price. Lower price means the future expected return is going to be higher, right? There is an inverse relationship between the price and the return, future return. So as more people are selling the stocks, the stock price is getting lower and lower, so the return of the stock is getting higher and higher, and the negative alpha is getting smaller and smaller until the stock return located on the security market line, there will be no actual incentive to sell the stocks. Then we reach the equilibrium point or more stable point. So again, negative alpha stocks are not stable equilibrium point. It can only be temporary. The equilibrium point return will always be on the security market line. To summarize, positive alpha stocks means the stock is located above the security market line. Those are undervalued stocks. People are trying to buy them. Negative alpha stocks means the stocks are located below the security market line. Those are overvalued stocks. People are trying to sell them. Now let's do an exercise. If you look at the picture, when beta equals 1, that is a market portfolio. The slope of the security market line is the market risk premium, which is 8%. Risk-free rate is 5%. Now let's try to fill out the missing values on the picture. First, we put 5% in the bottom of the security market line. And then we put in the market return, 13% for the market portfolio, because the market risk premium is 8%. Risk-free rate is 5%, so the market return is 8% plus 5%, 13%. To calculate the return of the individual asset with beta equals 0.5, we plug in all the numbers in the campaign model. We can back out the number, which is 9%. Then we can put that number in the graph as well. In campaign model, alpha should be 0 in equilibrium point. But temporarily, in reality, sometimes we can identify positive or negative alphas. The strategy for the active managers are whenever you identify positive alphas, you buy the stocks. Whenever you identify negative alpha stocks, you sell or short sell it. The key question is, how do we calculate alpha? We're going to calculate alpha in 3 steps. The first step is you want to calculate your own independent estimate of the stock return. We call it expected return delta. To estimate your return, you can use many models, any models you want. For example, the dividend discount model, which we will introduce in the later chapters. Okay, so first step, you estimate your own independent return. Second step, you calculate the expected return from the campaign model, plug in all the numbers in our campaign model, and estimate the stock return, and we call it should be return, which is expected return bar. In the next step, step 3, we'll take the difference and calculate alpha. So expected return delta minus expected return bar, or the difference of your own independent estimate of the stock return minus the campaign return. If alpha is positive, which is a buy signal. We're going to use the following extreme simple example to illustrate what is alpha and how we calculate alpha. Now our example is we have a hypothetical stock. The expected next period dividend is $10. Then the form disappears, so we don't have to worry about the future. The future is just a 1 period dividend, which is $10. Risk-free rate 5%, beta of the stock 1.5, market risk premium 10%. The current price, the P0, is $5, means the stock is selling for $5. And the next period dividend expected number $10. So those are the setup of the question. To calculate alpha, we follow the 3 steps. The first step is your own estimate of the expected return. In this particular case, so the P0 is the price you purchased the stock. So $5 divided by the dividends, $10 dividends you will receive in next period, in period 1. Let's calculate the return. So $10 divided by 1 plus your independent estimate of the stock return equals $5. You can back out the return, which is a 100% return. So this is your own independent estimate of return. The second step, we're going to calculate the campaign return by plugging in all the numbers in the campaign model. So risk-free rate 5%, beta 1.5 times market risk premium 10%. The expected return from campaign 20%. Finally, in the third step, we're going to take the difference. Alpha equals 100% your own estimation minus 20% from the campaign model, which is 80%. Positive alpha means you will overweight or buy the stock. Now we do some exercise. Would you buy a stock if the expected market return is 14%, beta 1.2, risk-free rate 6%, and you believe the stock return 17%? So according to the campaign model, we plug in all the numbers. The expected return is 15.6%. While your own independent estimate of the stock return is 17%, which is given in the question. So if you take the difference, 17 minus 15.6%, which is a positive number. Positive alpha means you will buy the stock. In the context of campaign model, the relevant measure of risk is beta. Beta measures the systematic risk, because in the campaign model, we do not care about firm-specific risk, because we are talking about a well-diversified portfolio. In a well-diversified portfolio, firm-specific risks are not relevant anymore. So that is why in the campaign model, we do not use standard deviation as the measure of risk, because standard deviation measures the total risk, which is the sum of the market risk and the firm-specific risk, while beta only measures the systematic risk. That is why we use beta in the campaign model. In a related question, according to the campaign model, a well-diversified portfolio's rate of return is a function of what type of risk? Again, we choose A, market risk, because a well-diversified portfolio, you shouldn't worry about firm-specific risk anymore. The only risk factor you are facing is the market risk. Your personal opinion of the stock is it will yield 11% return. So this is your expected return total, your independent estimate of the stock return. Beta 1.5, risk-free rate 5%, and the market return 9%. According to the campaign model, the security is C, because let's compare your independent return 11% with the campaign return by plugging in all the numbers to calculate the number. So when you plug in the 5% risk-free rate plus 1.5 beta times market risk premium, which is 9 minus 5%, the campaign return is also 11%. So the alpha is 0, means the stock price is very fair. Another question to calculate alpha. Risk-free rate 7%, expected market return 15%. You expect stock with beta of 1.3 and offer a rate of 12%. So here the 12% is your independent estimate of the stock return, 12%. To judge whether the stock is over or underpriced, you have to calculate the campaign return and compare that to the 12%. To calculate campaign return, you plug in all the numbers. 7% risk-free rate plus 1.3 beta times market risk premium, which is 15 minus 7%. The campaign model yield a 17.4% return. Compare that with your 12% independent estimation. Alpha is negative. Negative alpha means the stock is overpriced and you should sell or short sell the stock. According to the campaign model, in the equilibrium point, all fairly priced securities should lie on exactly the security market line, which means zero alphas. Now I have a tricky question. We have two portfolios, portfolio A and B. Portfolio A has a beta of 1 and high specific risk for each individual stock. Means within the portfolio A, all the stocks have very volatile returns. Portfolio B has beta equals 1, but the low specific risk for each individual stocks. Within portfolio B, all the stocks have very low volatilities. Okay, now under the campaign model, assume both portfolios are well diversified. Which one do you think will have a higher return? The correct answer is both of them will have the same return, which is the market portfolio's return, because whenever beta equals 1, that is a market portfolio. So both portfolio A and B are market portfolio and giving market returns. Since both portfolios are well diversified, then we do not need to worry about firm-specific risk. So we don't really care about the volatility of the individual stocks in the portfolio anymore. The only risk that matters is the beta risk or market risk. In previous chapter, we have showed you when you have to choose between the risky portfolio and the risk-free asset, you have 3 steps to do. The first step is you want to form the efficient frontier by looking at the asset allocation of risky assets only. The tangent point of the efficient frontier and the capital allocation line, portfolio P, is the optimal risky portfolio. On the capital allocation line, each individual investor will have different indifference curve, or you can think of that as utility functions. So the tangent point of the utility function and the capital allocation line, that is your optimal complete portfolio. In the picture, we have the portfolio C. The theories of mean variance efficient portfolios are very neat in theory. But in reality, when we try to implement the models in the real life, it's going to cause a lot of trouble because we will have so many inputs for the portfolio selection. Now suppose we have a portfolio of N stocks. Let's see how many inputs we have. First, you need to estimate the risk-free rate, which is relatively simple to do. You just estimate the T-bills return. The second step is you have to estimate N returns and N variance of the N stocks in the portfolio. So each stock we have to estimate return and the variance. And to calculate the portfolio's variance, we also need the covariant terms of all the stocks you hold. Mathematically, how many covariance terms do we need? We are going to need n times n minus 1 divided by 2 covariance estimates. Well, it's easier said than done. For example, if your portfolio is the S&P 500, which means in this S&P 500 portfolio, we'll have to estimate 500 stock returns and 500 stock variance. And how many covariance terms? That is 500 times 499 divided by 2. That's a lot of estimations. And what makes it even worse is even one estimate of the input is not accurate. Your overall conclusion is not going to be correct. If any one of the campaign model assumptions is violated, then the campaign model is false. And most of the assumptions are very hard to hold in reality. The question is, why you still need to have the campaign model at all? Well, first of all, the campaign model can still be a very useful predictor of the expected returns. All the principles and theories are still valid. So first of all, investors should diversify. You shouldn't just hold one stock in portfolio. The second takeaway is systematic risk is the risk that matters because you are going to hold a well-diversified portfolio. So from specific risk is something you can forget about it. The last takeaway is well-diversified risky portfolio can be suitable for a wide range of investors. Within the model, basically, every single investor should hold the market portfolio, which is well-diversified risky portfolio. Campaign model is a one-factor model. The only factor is the market risk premium. So basically, under the campaign model, stock return is only proportional to one factor, which is the market risk premium. But what if we have other factors that also affect stock returns? Can we have multi-factor models? The answer is yes. We first take a look at the two-factor models. In the two-factor model, we are going to introduce a second term, which is the risk premium of the treasury bond portfolio. So the two-factor model looks like the following. The expected return of stock I equals risk-free rates plus a regular campaign model term plus the second factor, beta TB, which is the sensitivity to the interest rate, or you can call it T-bond beta, multiply the risk premium of the treasury bond portfolio. To calculate the second term, the risk premium of the treasury bond portfolio, we need to calculate the long-term treasury bond return, the expected RTB first. Then we take the difference of the T-bond return minus the risk-free rate, which is treasury bills return. Here is a numeric example of the two-factor model. Suppose we have a stock called Fly High Airlines. The market beta 1.2, T-bond beta 0.7, market risk premium 6%, T-bond risk premium 3%. What is the expected return on the stock? We plug in all the numbers in the two-factor model. So 4% risk-free rate plus 1.2 times 6% plus 0.7 times 3%. 13.3% is the expected return from the two-factor model. Finally, we are going to introduce the most famous multi-factor model, which is Farmer-French three-factor model. In the three-factor model, the first factor is our regular campaign model factor. Again, we have the market beta and market risk premium. The second factor is called value versus growth factor, which is the difference in returns in stocks with high versus low ratios of book-to-market value. Stocks with high book-to-market value is called growth stocks. Stocks with low book-to-market value is called growth stock. So in the factors, HML stands for high minus low. This factor is inspired by the empirical studies that show historically value stocks or high book-to-market value stocks always outperform the growth stock or the low book-to-market value stocks. The third factor is called size factor, which is the difference in returns in stocks with big versus small capitalization. Capitalization is the size of the stock, which is price per share times total number of shares outstanding. So SMB stands for small minus big. This factor is inspired by the empirical studies that show small stocks historically outperform the big stocks. Farmer-French three-factor model is very important. It is now considered as a standard tool for any empirical studies of asset returns. When we add additional two factors, size factor and book-to-market ratio factors, to explain the average return, empirical studies shows the model estimation of the Farmer-French three-factor models are better than the campaign model. The additional two factors are motivated by empirical studies. The first one is returns on stocks of small firms are higher than the returns on stocks of big firms. The second one is the returns on stocks of firms with high book-to-market ratios are higher than returns on stocks of low book-to-market ratios. Those two important empirical findings are the motivations of the additional two factors. Let's estimate the three-factor models for a particular stock, Ford. So first of all, we are going to use historical data to estimate three betas for the three factors. In this particular example, we are going to use monthly data from 2011 to 2015. We are going to use the historical data to estimate the betas. In the following table, we can see the betas for campaign model and the three-factor model. In the campaign model estimation, beta of the market risk premium is 1.326. In the three-factor model, the beta to the market risk premium is 1.235. The beta to the small minus big is 0.246. The beta to high minus low is 0.692. If you look at R-squares, the campaign model has R-square of 0.394, while the three-factor model has a higher R-square, 0.426, which means the explaining power of the three-factor model is better than the campaign model. After we use the historical data to estimate all betas, now we can actually use the betas to make predictions of the stock return. Now suppose the risk-free rate is 1%, market risk premium 6%, risk premium on small minus big 2%, risk premium on high minus low 3%. Let's use the estimated beta in the previous table to calculate stock expected return for Ford. In the campaign model, we plug in the number of beta equals 1.326. And the campaign model predicts the return for stock Ford is roughly 9%. Using the three-factor model, we plug in all three betas from the previous table and all the market risk premiums. We calculate the stock return is roughly 11%. Now you may have the question, you have two returns from two models. Which one is better? Well, for all stock returns estimated from models, there will always be model estimation errors. None of the models will predict 100% accurately. Empirically, when we study stock returns, people prefer to use the three-factor models to capture more risk factors.